All right, this first stretch of the first video for the 7th chapter is going to focus on some basics about payroll taxes, just to give you sort of a primer on what we're talking about here. Right now, the first big concept is, again, what are we referring to when we're going to even deal with payroll taxes? We're only talking about employees here. Now this is a basic definition that it uses a guideline for determining whether or not somebody is an employee or not. Again, if an employee is somebody who works under direct control and the direction of the business. So in other words, it's somebody who is usually going to be like directly hired by your human resources department. They're going to be salaried or waged accordingly. Again, whatever their tasks are will be directly controlled within the business. So if it's somebody that sounds like that, we're talking about an employee. Now, if we have somebody who works for fees or hourly rates, and they can't be told exactly what to do right there. Like, you can give them some direction, but otherwise their tasks are pretty much outside the control of the business. That's an individual we're going to refer to as an independent contractor. So in that case, if we're an independent contractor, everything we're talking about here doesn't, pertain to them. So again, if we're talking about hiring a lawyer, an accountant, or a stockbroker, those are all classic examples of independent contractors. And just to go back to the idea of salaries and wages, those terms are used in this video, and then its accompanying handout synonymously. There's no difference between those two. Now, if you're talking about dealing with an employee, the first thing most employees are going to be required to fill out is this form called the W-4, which is basically, the purpose of this is withholding allowances, right, which I'll talk about in 1 second here. In other words, how many exemptions do you plan on taking as an employee in preparation of federal income taxes? Now, what happened is the law passed in 17, which is applicable to 18 and beyond. It's applicable this year in 2020 as I'm doing this video. It doesn't recognize allowances, so really we're just using W-4s right now to determine marital status. So in other words, where you would be on the tax tables, single versus married. Those are your two basic lines of demarcation right there. Now you'll look up in the blackboard for this class, and you'll see something called Federal Income Tax Withholding for 2018. It details the correct amounts to deduct based on marital status, wages earned, and the frequency of payroll, which can be weekly, bi-weekly, monthly, or even daily. And again, allowances no longer apply, so it's actually become a simpler tool because of that. And the examples that you see in this handout are consistent with that PDF file. And of course, again, a more up-to-date file for 2020 would be applicable, but again, it's mostly for reference anyways. As you'll see in a moment, I don't expect anyone to actually be referencing those federal files anyways when you're doing this in practice. All right, next up, again, employees can be either paid hourly wage or weekly salary. Now, something you have to understand about the Fair Labor Standards Act is that overtime pay applies at a rate of 1.5 times the hourly rate to all wage employees whose hours in any given work week exceed 40. So that's the line right there. Anything over 40, you've got to pay them time and a half. So example here is Mike's going to make $10 an hour at Home Hardware. He worked 45 hours for the current week, so his base pay at the regular rate would be $400, which is 40 times 10. His overtime pay is going to be $75 because in other words, those 5 extra hours, he had to be paid $15 an hour based upon the overtime rule. What if you're salaried, but you don't make that much money? Like your salary is somewhat small. Now, if your salary is less than or equal to $455 a week, we're going to treat you the same as a wage earner, and you're going to also have to be paid overtime pay. Now, there was this threshold we're looking at. This goes back to the 70s. I mean, this is super old. There was going to be an upgrade in it, or I believe there was an upgrade of it, but it was rolled back by the current administration. So because of that, this is pretty much the standard we're still working with. So the idea, the possibility of having somebody that we have to do this for under the current situation is pretty small, because the new rule that was implemented temporarily upped this to basically taking into account the cost of living since then. It was people making over $50,000 a year of salaries would be treated as an hourly employee, but now it's back down to this absurdly small, like $21,000 or $22,000 a year, whatever. But probably not going to be a salaried person at that rate. Excuse me. And so what we're going to do here is we're going to convert this to an annual amount, then convert to weekly, then hourly rate. So this is how you would tackle it. So figure out. So if somebody was salaried at $1,800 a month, that equals 21,600 per year times 12. That's all we're doing there. Now divided by 52 weeks, that means this is what they're making per week. And we'll say, okay, that's their base on a 40-hour work week. So that comes out to $10.38 an hour. So the adjustment for the hour and a half, overtime rate for this individual. So every time they work an hour above 40 hours, we'd have to pay them $15.57 an hour. That's just 1.5 times our $10.38. It's just more FYI. You're probably not going to encounter it, but it's just something I included in the material. Right. Fifth, employers pay a matching FICA tax. And again, FICA tax is just two facets there. Social Security and Medicare. We talk about FICA taxes. It's going to be equal to the amount deducted from the employee's wage. So the Social Security rate stands at 6.2% applied to wages. And again, this is the threshold in 2018. And again, this threshold changes each and every year, but the idea behind it doesn't. In other words, we stop subtracting Social Security from an employee's wages and salaries after they hit $128,700 this year, or if the current year is $135,000. Whatever the number is, that's the ceiling. Once you hit that amount, you stop collecting Social Security, and likewise, the business doesn't have to match it anymore. That's the other important thing here. Now, Medicare, the Medicare rate is 145, that is to all wages, and increases to 235 if you exceed $200,000 or 250 if we're talking about a married tax filer. Now, the thing about Medicare is, again, there's no threshold on that. There's no ceiling on that. That's applicable to all wages. And again, it actually goes up after a while. But the thing to understand about that extra 0.9% is that's exclusively going to apply to the employee earnings. Employers do not have to match that. So employers will only have to match this right here. They got to match the 145, but everything above that will only come out one-sidedly from the employee's wages and salaries. Nothing else other than that. Now, last basic concept here is employers are solely responsible for paying unemployment taxes. Again, this is under the Federal and State Unemployment Tax Acts, which are abbreviated FUTA and SUTA. Not the most elegant abbreviations, I know, but there they are. Now, your base federal rate is going to be 6% applied on the first. Now, look how small this is. This is a very, very low ceiling. $7,000, that's it, earned per employee. And again, what we do is we're going to take the 6% rate and we're going to adjust it downward for participation in the state programs. But again, the minimum federal rate you're going to pay in is 0.6%. So that means, in effect, most states are going to do what? They're going to collect the 5.4. That's going to go to the state, and the 0.6 is going to go to the federal government. So really, when you're talking about unemployment funds collected, those are mostly collected at the state level, not the federal level. There's some money at the federal, but it's mostly at the state level. Now, here's the thing, though. Each state can enact, by law, their own rules regarding what the ceiling is and rates are for the state, right? So that 5.4 portion here. So we're going to look at the rule for the state of Illinois. Again, this is the concept doesn't change, but maybe some of the amounts have changed. So for 2018, state of Illinois, their ceiling was $12,960, not $7,000, $12,960, and the rate here was nothing all the way up to 6.4%, so a point fully higher than the 5.4 that's mandated by the federal government. Now, again, with this state, the state of Illinois employs is what's called a merit system, which is kind of like it sounds. In other words, if you stimulate less unemployment because you don't have a lot of turnover, we're going to lower your rate to something much less than the full rate. And again, if you have, let's say, no turnover, we might insist that you pay nothing in, right? So again, employers with high turnover would pay a higher rate. The 6.4, while those with little no turnover would pay nothing yet receive credit as if they were paying the full 5.4 to the state. So in other words, the idea here is that the high turnover employers subsidize low turnover employers, and that's the way it should be. Because if your business has a very stable, payroll, like you have a few employees that have been working for you for years, you shouldn't be paying that much into it because you're not really, you're not stimulating unemployment claims, right? Whereas employers, let's say, fast food joints, classic example there, they have a lot of turnover, so they're probably going to pay the highest possible rate because of that fact. Right, so an example here, just so you understand what we're talking about, a low turnover employee in Illinois would pay like the 0.6% on the first $7,000, because that's going where? That's going to the federal government, and that's only, we're talking about $42, and then nothing. In other words, this is somebody the state of Illinois has determined, again, you have like 3 employees that have been working for 10 years, they're going to say, well, we're not going to ask anything from you. You're not simulating any unemployment claims. You have a very stable work environment in terms of your employees. So, pay the 42 to the government, the federal government. We're done with you. Now, if you're somebody who's a high turnover employer, you'd have to pay 7% on the first 7,000, right? So that's 490, and again, that includes 6.4 to the state. So in other words, the federal government's still only getting $42 of that. Everything above that, so that would be the other $448 would go to the state of Illinois, and then they'd pay another 6.4% on the next 5,960. So it would be another $381.44. So that's somebody who was at the top of the scale. Obviously, there would be examples of companies, businesses that are in the middle of that scale there, but you get the idea. Now, again, to simplify things, for purposes of simplifying all this stuff, everything is going to be assumed with a $7,000 ceiling applying to both federal and state, and the maximum combined rate is 6%. Just a simplifying assumption. Just letting you know, though, when you take this out into the wild, so to speak, I sometimes refer to that, things can get a little bit more difficult. We're going to look at some of the basics of employee payroll taxes and then conclude this first installment, and then we'll go into an example of how to handle employee payroll taxes in the next one. Again, I can't emphasize this enough. Due to the arduous nature of employee payroll taxes or payroll taxes in general, again, acquiring payroll tax software is highly recommended. In fact, I would say you would be incredibly foolish to even try and do this on your own. Get some software that can tackle this, that would be updated with updated rates and also changes in the payroll tax laws as they occur. You might be expecting there might be another change in payroll tax laws coming as soon as next year. So again, because of the fluid nature of this, the software is the best way to go if you really want to stay on top of this. So any type of package is going to be set up so that you can have a very active employee earnings record. And again, the idea of this earnings record is this is going to flow to what we call the payroll register, which is just a comprehensive ledger that lists every employee's earnings by, you name it, by pay period. Doesn't matter if we're talking about weekly, bi-weekly, or whatever the case may be. Also, the base information for each employee would be included in here. So all the stuff you would expect to see. Name, address, job title, social security number, and marital status would all be included in that payroll register and the accompanying earnings record as well. So here's your basic formula for payroll tax entry. So you'll start with the gross earnings. In other words, what you've agreed to pay your employee minus all of these amounts. You notice they all have what in common? They all show up as some kind of payable, right? There's something payable. In other words, these are amounts that are going to be ultimately have to be paid somewhere by the by the employer. So again, can't stress the need for software enough, because all the different timings of when you have to pay these amounts to these various organizations and entities, it's all over the map. It's crazy. I've seen books try to list out what the timing of all this stuff is. To dedicate that to memory is an exercise in absurdism. There's no need to do it, because again, they sometimes change, and they change if you're below this threshold or above that threshold or whatever. So it's just craziness. So again, get some software here, but again, I want you to understand the basics of what the software is doing. So that's the thing we're really most emphasizing here, is understand what's going on there in that quote-unquote black box of the software if you do obtain it. So it's going to be minus federal income taxes payable, Social Security, Medicare, other deductions payable. We'll see examples in the next video of what I'm talking about there. All those deductions will equal the net payroll payable to the employees. In other words, whatever you ultimately end up adding to your employees' applicable accounts if you have an EFT situation set up, or whatever you cut the check for. And again, other deductions include, this is not comprehensive, just a few things here. Health insurance, union dues, state income taxes, 401k, and charitable contributions. Any deduction imaginable would be included in that other category there. So here's the example that we're going to build on in the next video here. You'll see this slide again just for reference. So we have YYZ Corporation has 5 employees, which is Dave, and all I give is their marital status, because again, the number of exemptions they want to employ doesn't mean anything anymore under the current tax system. So just marital status is going to matter here. So we have Dave's married, Jenny's married, Mike is single, Mindy's also single, and Steve is married. And again, Steve is the owner of YYZ. All salaries and wages are paid bi-weekly, And here's the basic information. Dave and Jenny are going to earn $2,000 every 2 weeks. Mike and Minnie's hourly rate is $12 an hour, and Steve earns $10,000 every 2 weeks. On June 29th of 2018, year-to-date earnings and other info for all 5 are as follows. So I'm going to conclude there, and again, you'll see this slide again in the next video, which will go through tackling the payroll there, and also how the journal entries will look and whatnot. And we'll go into the employer payroll taxes as well. So see you in the next video.